individuals' income tax and business tax returns. So California did a different, actually, that's probably a good place to start because it's really a very commonly discussed thing in my office. So the PPP loans, if your business was having difficulty at the beginning of the pandemic, paying certain things, primarily payroll, because we didn't want businesses to lay off lots of people, or cover overhead like rent, supplies, things like that. The PPP loan program was designed to prop those businesses up because COVID was only supposed to last, what, 6 months? So that was the intent. And then at the end, when your business was flourishing once again, the loans would be paid back under very favorable terms. So that's how it developed. Well, we didn't have this pandemic disappear in 6 months, as we all know. It's taking a little bit longer than that, which is why this room isn't full of men. I understand it's a breakthrough to have, what, 7 people here today. So that's fantastic. And then Washington, they said, look, we're not going to make you pay this loan back, which was really great. And some businesses, it was survival for them. Other businesses sort of abused the system. I mean, the Lakers got a PPP loan. Many flourishing businesses got PPP loans. And many of them paid them back because the public scrutiny was pretty bad. And so after a period of time, government said you don't have to pay those loans back, which was great. California was kind of in limbo with that. California decided, okay, we'll take that approach of you don't have to pay or include this income that we've forgiven as income on your tax return if your business declined at least 25% during at least 1 quarter of when we loaned you the money in a year later. So, I mean, in California, many of the returns I'm preparing now for businesses that got this money, they will have income in California, not federal income for the forgiveness of these loans that went out. I guess all that to say, I was starting to talk about the BBB, the Build Back Better plan. That was a very expensive program, the PPP. So somebody's got to pay for it. And I'm anticipating some tax law changes going forward that won't necessarily be in our favor. We've had some pretty good years. I think in 2018, maybe the best new tax legislation in 20 years came through. And I'm going to mention one of the things that came through. I know many of the people from home that are watching are self-employed, so I'm not going to ask for a show of hands, but most of the clients that I help, the clients that I help the most, let's put it that way, are probably the self-employed clients. Because the way the tax rules have been designed is not to punish the people that are W-2 employees, but really to give them very few opportunities for deductions. And I'm going to talk about some deductions that we may or may not know about, but for the most part, small business really cleans up in the tax world. I'll give you an example. In 2018, we had a new administration coming in. The qualified business income tax deduction became a thing. It is a 20% reduction of taxable income for businesses. So let's say your business made $100,000 profit after you took out your expenses. That provision said you're only going to pay tax on $80,000. So it's pretty big. It's a very big deal. It's federal and not state, but it's been very beneficial to small businesses, again, to kind of prop them up. There are certain businesses like mine, like law, like medicine, and unfortunately engineering is kind of one of the ones that they've poked at. If your income's at a certain level, you're not going to get that deduction. But it's still a very valuable deduction. And again, emphasizes the difference between a W-2 employee who gets very little write-off as opposed to a business that gets quite a bit of write-off. So it really makes a difference. But people can kind of abuse the system with a small business because if you take a salary, you can say, well, I want to have my S corporation pay I want to get the bang for the buck out of that qualified business income deduction. So I'm going to take a low salary. Well, I'm not going to get too far in the weeds with this, but that will backfire because it reduces this individual's ability to put money into a retirement plan. So there's that. Unemployment benefits. I don't know how many people in this room or in this audience had experienced unemployment in 2020. Many people did. And so we got unemployment payments not only from the state of California, but the government, federal government piggybacked, I think, $600 on top of the regular weekly pay.
Yeah.
So it was a pretty good amount.
Thank you. It's fine.
Someone else jumped in. Anyway, I'll keep talking unless somebody throws something at me. The unemployment benefits that we collected in 2020 for many of us, partially tax-free, which was kind of a good thing. It was caught late in the year, and not caught. The IRS said that certain amounts were not taxable later in the year. Many people had filed, so the IRS kind of got involved and said, okay, we'll just send refunds to the people that had unemployment benefits. So I guess where I'm rolling with this in another way is the Build Back Better program will probably pass to some extent this year to pay for all these things that I'm talking about as previous, tax benefits related to the pandemic. The unemployment benefits for those unemployed people in 2021, there won't really be any reduction. It's going to be fully taxable income on the federal side, not on the state, but it's been something that's kind of a gotcha because people are continuing to be unemployed. I should say this also. Some people have chosen to be out of the workforce for a variety of reasons. Some of them perfectly legitimate. Maybe they want to stay home and raise a family. Maybe they want to just take a break and do some introspective soul searching about who they are and what they want to be. But a certain contingent are people that simply like getting a check and don't see themselves going back to 40, 50, 60-hour work that they previously did. So not a social commentary, but it's been a big financial burden on the government to supply those people with unemployment, benefits for as long as they have. Incidentally, I mean, I've even me as a CPA firm, getting additional help during tax season has been a challenge, in particular in our Fremont office. So there's some new things that are good. I mean, we're still talking about things that we'll need to get paid for at some point. Child tax credits. They decided to advance some child credits for having children. Most of these things that I'm talking about are income sensitive. So income sensitive simply means most of the people that live and work in the Tri-Valley and the Tri-City area are not going to get these benefits because their income is exceeding a certain guideline. So there are people potentially in this audience that if they don't have a situation like that, they know someone who will. By the way, I don't know if my contact information is in here. I love getting emails about questions. No charge for that. If someone says, hey, I saw your conversation last night and I have a kind of an oddball question, I'd be happy to answer it. So I'm not sure how we'll get contact information out there. And one of the reasons, other than I'm sure you're all good guys, is the IRS is inundated with work right now. They haven't filed, I think I wrote the number down as far as, okay, so they are still filing 2020 returns at the IRS. They are answering approximately 10% of the phone calls at the IRS. So making myself available for a question that would otherwise be an IRS phone call, I'm happy to do that. I'm not looking for work. I'm just saying that I'd be happy to help someone out who's just about done with the return, have a question, and they want an answer. So they've created at the IRS, related to this point, an inventory. They call it, great names. I don't know where they come up with it, but they call it an inventory surge team. What that means is they have an inventory of unprocessed tax returns that they got to deal with. They got to get to it. And they've pulled people from all other departments within the IRS to continue to process, again, 2020 returns, not 2021. These are 2020 returns. If you filed an amended return, which, you look at your return and go, I forgot to deduct, I gave the church $5,000 at the end of the year. I forgot. I want to take that right off. So you amend the return, that's 18 months to 24 months to get your refund. And in the old days, when they were efficient, 3-4 months tops. So it's new territory for us as preparers. But there's a silver lining there. They're too busy to do audits. So we have around 1,000 individual clients, many business clients also, but about 1,000 individual clients. I had two, I checked before I came tonight, 2 audits last year. 2. normally 30 to 50, I'd say, in that population. And not because, I'm overly conservative, but it's just they don't have the manpower. They simply don't have the people to conduct audits when they haven't processed returns last year where people are, expecting refunds. And that's kind of held up in Roy's world, in the real estate world. It's affected people refinancing and borrowing for a house that they want to purchase, because one of the qualifications is they want to verify that you give them a tax return, and they say, well, you could have just prepared this on TurboTax and handed it to me. We want to verify with the IRS that this is a return that they have in their system. Well, again, we're still working on 2020 tax returns. They're not all processed. So I imagine that that's rippling down into the refinance and purchase market. So taxes is pretty much, pervade our life in many, many different ways, unfortunately, or fortunately. When you get a stimulus check or when you get a free loan, then taxes, when you get forgiven on your tax return, then I'm Santa when you come see me. The other thing they're not doing because they're too busy is sending out and processing penalty notices. So normally they have computers that process a penalty notice, and then a human being gets involved to where a penalty would come into play. Let's say you computed your taxes incorrectly, and you got a notice that said you owe $100, you owe $1,000 plus a $200 penalty. You just say, well, I don't feel like paying a penalty. I'm just going to send the tax money in. Many people choose to do that. They won't come after you. I'm not telling, by the way, please don't interpret that to say if you owe some money to the government, don't pay it. I think I'm in the wrong room for that. But I'm saying and I'm not saying they're kinder and gentler at the IRS or the state for that matter. They're just too busy to bother is what I'm saying. But that wave will turn. And it's, I was talking to my partner today about this, about how if the government, particularly the IRS, were a business, they would have failed decades ago. Because if I'm a car lot and I'm struggling financially, I don't fire my best salespeople. I fire the accountants. They don't bring in revenue. The salespeople bring in the revenue. Well, the IRS essentially is redeploying and laying off and not replacing their best salespeople, which are their auditors. So they're just not. So the government is losing potentially lots of money. Again, please don't interpret this as hey, maybe that dog I can get a Social Security for and claim as a dependent. Not me. No, that's not what I'm saying. I'm just saying that it's a different landscape out there right now. So one thing we have on our website that's helpful, because we have so many returns where refunds are due and they're not being processed. We have an app on our website, and it's also on the IRS website, called Where's My Refund? It's click it, put in some personal information, and they'll say, we've processed your return, we're reviewing it, check's in the mail, check's been sent, you should have it. So there's the different kind of levels of information that can be helpful, to you as you, anticipate getting money back. One thing that they determined that last year, and this is, again, related to their backlog, is they sent out 14 million notices that there was a math error on a tax return. So it's again creating many unfortunate situations for people that had money coming back last year. And most people that filed and owed money, they haven't processed a return, but if they filed, they paid. So we're really talking about people that are due refunds and haven't received them. The IRS is supposed to pay you interest when you have a refund coming. They don't always do that, but we'll see. So I'm just kind of backtrack a little bit and talk about the typical things that people write off. Everybody wants to know what can I write off? Well, as a business, it's pretty simple. If it's an ordinary and necessary expense related to a particular business, Roy would have a broker's license fee, sign fees, staging fees, things like that. If it's ordinary and necessary for your business, it's a write-off. As long as it's not lavish or extravagant. And you kind of know it when you see it with the lavish or extravagant part. It's something that your accountant, whoever you're working with to do your taxes, they should say, look, if you have $25,000 in income from being a landscaper $8,000 entertainment expense is too high. So that's the kind of thing that we're looking, people expect from us. It's not, we know when we see it, that's the kind of thing for a business. Certain things they accelerate, the write-off in a business, like vehicles, like equipment, things like that. You can write off faster than you're paying for them. Typically a person buys a car and they have 5 years of payments. But if it's a work truck, something that is necessary, you can write that off more or less immediately in most cases. California has a limit, but the IRS is going to give you mostly a full write-off, which is pretty cool. And again, the business self-employment world is where most of the deductions are. And if you have a self-employment situation, you fund your retirement programs kind of contingent on your profit, and you can decide what kind and how much to put in and that type of thing. For those who aren't in the self-employment world, there's an itemized deduction world where deductions are possible for you. Some of them are limited. Again, we're based in an area that income is fairly high. So many of these things kind of disappear. For instance, I had a conversation this evening with the last couple that they had a child, which is a great thing. And they had significant medical expenses, but medical expenses are deductible to the extent they exceed 7.5% of your income. So in real terms, if your income's $100,000 and you have $7,800 worth of medical expenses, your write-off is $300. So it's one of those things that you got to have the perfect storm, which isn't a good one, which is low income, high medical expenses. So I don't see it very much. Where I'm starting to see it a little more as my client base is getting a little older are the fees for residential facilities. The one very close here, Stone Ridge Creek. Many of them are like hotels. I mean, they used to be horrible places that they would be not places you'd want anybody in your family to be. Now some of them are pretty nice, very expensive. So they've determined that the fees associated with those facilities, for the most part, are going to be a medical expense. So that could really propel you. I mean, many of these fees are $6,000, $7,000, $8,000, $9,000 a month. So it could put you in a situation in that situation into a deduction format. The next category is taxes, which used to be a really great place to write things, to get a big, huge deduction. Since California is such a tax state, our income tax rate here is maybe the second or third highest, if not the highest, when you add everything in. And we used to be able to deduct our state income taxes. And then we had the tax law in 2018 that says, well, we're going to let you do that, but we're going to limit it. It's a severe limitation. It's called the SALT limitation, state and local taxes, including real estate tax, deductible to the extent it's less than $10,000. Not really very fair to people that live on the coast. And that's, I think, the intention of the individual that was the proponent of that legislation. So that there is a proposal in the Build Back Better program to increase that 10,000 limit to 80,000. Might get some relief. But my experience, and I mentioned a term that if it affected you, you're going to shake your head. The people that had high state income taxes in old days were subject to what's called the alternative minimum tax. And what that is it's a separate tax calculation, and it deducts all kinds of things, but not state income taxes. And then whatever your income was, you get taxed at a flat rate. It's still in the law, but because they limit the state income taxes to $10,000, doesn't affect too many people. But it might come back if they increase it to 80,000 for a deduction for state and local taxes. Certain other things in that category are sales tax. If sales tax is higher than your state income tax, that's potentially the case if for instance, you don't make very much money and you have a high mortgage and you have, relatively low real estate taxes, and you might have bought a car or two, then that might help you. DMV fees is in that same category. Real estate taxes are in that same category. And many people, speaking of that, since again, California has different tax laws, they don't dovetail at all in many cases. California still allows you to deduct your real estate taxes. Here it could be very, very high. They're not limiting that same deduction to $10,000. You can't deduct state taxes on your California return, but you can deduct real estate taxes. So it's important not to eliminate it just because you're more than $10,000. Real estate also comes typically with a mortgage. So mortgage interest has been pecked away at also. In the past, it was as high as $1.1 million of debt associated with acquiring a home. The interest on that was fully deductible. They've knocked that down to $750. Now, if you're in Wichita, you probably could buy the most expensive house in town and your mortgage would be way less than $750. I don't even know when I've seen recently for someone recently acquiring a property where there was debt in the Tri-Valley that was less than $750, unless they threw a huge down payment down. So that's a real limit. California, still $1 million. So again, you have to really look at these two returns as not just intersecting in every way. They probably don't. They probably have some nuanced differences. Then the donation, something interesting, and I know a client that may be watching that did this, and I'm not going to mention his name, but it's a great move, is the donation deduction. I'm going to stay on the Schedule A for a second and then say something about a client that did something. You can donate a big part of your income to this type of charity, up to 60%. It's not really a realistic number. In other words, you can deduct everything you want to deduct in terms of cash and credit card donations to church and other organizations that are worthy of your donation. Where it gets a little complicated are things like non-cash donations. Many people come in and just tell me that they donated 5 bags of clothes 10 times last year to Goodwill. If that's the case, I'm stuck. I can deduct $500 for them. But if they keep those little receipts, the ones that you basically fill out, they give the form to you and you write in, what you think it's worth, up to $5,000. So it's important if you're doing that type of thing, you're dropping off to Salvation Army and Goodwill and those Shepherd's Gate's another one out here, that accepts that kind of donation. It's real important that you keep the receipt, because each receipt all assign a value of significantly higher than just the 500 limit for the whole year. Another thing that people forget, mileage related to your work here in the church is deductible. So you should be tracking your mileage so that at the end of the year, you can get a nice, I believe it's 14 cents a mile. I mean, if you're here regularly and you come from any distance, it can really add to your donation value. If you had this question this morning from a family in Montana that buys donuts. They have 2 services at their church, and they bring the donuts that the people eat between services. Fully deductible, it's fine. And I've never had an audit. I've been doing this since September of '88. Never had an audit for charitable contributions, not one time. I guess the people that are generous are also normally, ethical. Who knew? And then a whole section went away from the IRS tax return Schedule A itemized deductions. Whole section. It could be a big section. Miscellaneous itemized deductions, which include union dues, your fees for your broker, the fee that you pay your accountant. If you're not a self-employed person, we can move the expense over to self-employed. Supplies for the work that you do, unreimbursed employee expenses. I mean, here's a big area during COVID is many employees were forced to work at home, and the companies didn't always reimburse them for all the expenses that they had at home. So they incurred a remodeling of their office, supplies, technology, things like that, so that they could work at home. And a lot of times the companies picked up the tab, but not always. In those situations, in the old days, pre-COVID, pre-2018, could write that off as unrelated employee expense, unreimbursed employee expense. On the IRS form, it's gone. So that is a deduction that people, because it's on the IRS return, tend not to give me the information for, but it's still a deduction on the state return. So those things are again, differences between the federal and the state filing. I'm gambling. I'm not sure anybody here pulls handles or, is a poker whiz. Gambling losses are deductible to the extent of gambling winnings. So almost 100% of the time, there are losses to accommodate the winnings. Just kind of the nature of the beast. I mean, and once in a while, one off. In fact, I will see him in Fremont tomorrow. He inherited lottery. He had an uncle that didn't have any family, didn't have a wife or children, but had him as nephew. and he bought a lottery ticket and won, I think, $13 million. He opted for the payment plan. 2 years in, done, went away. Uncle dies, and my nephew client slides in there, collecting a nice check. I think he's got 1 more year left. But yeah, so he then, so whatever his trip, because it's gambling winnings. So if he were to go up and spend a week in Vegas and drop whatever he drops, that is going to be an offset. It's going to actually be a write-off. Very unique situation. Not a gambler myself, but kind of an interesting tax benefit for that individual. Now I'm going to circle back. So this client I'm talking about, who may or may not be listening, there's something that you can do with your required minimum distribution. Now, what that means is for people that are old enough to have to start taking money out of their IRAs, there's the ability to divert up to $100,000 from your IRA to a charity like this church and like other organizations. And why is that even useful? Well, let's say you've paid off your house. You've lived there for 40 years. Your mortgage interest is gone. Your property taxes are very low. You and your wife are old enough to get a nice, healthy $28,000 charitable standard deduction, which is what you do when you don't itemize the standard deduction. This is allowing you to essentially get a charitable contribution deduction off the top of your retirement. So let's say you had to take $150,000 out of your IRA because you're a certain age, they make you do it. You could say, just give me 50, give the 100 to the church. And effectively, you've gotten the standard deduction and you've gotten another 100,000 charitable contribution that you didn't need because you weren't in an itemized deduction situation. So it sounds way more complicated than it is. You'll probably be almost home when you realize that may be a good idea when I'm old. So that's one of those things that is out there, relatively new. The potential, now just a few things before I share a little bit about my faith. The potential changes related to the Build Back Better plan are kind of scary. They would affect some people in this area in a big dollar way, like it would cost a lot of money, but counting heads in the country probably wouldn't affect that many taxpayers. I'll give you just 3 quick examples. One is a 1031 exchange. 1031 exchange is also known as a like-kind exchange, a starker, a deferred. It's called many things. Essentially, in the old days, if I didn't like my rental property and my friend down the road had a rental property that I liked, we could have lunch and say, tell you what, you like my property, I like your property, why don't we trade? And so it starts out that way. In the tax law, the case that Starker that went that way kind of had a few nuanced differences, but what it's evolved to is a situation where I can and have recently sold a piece of real estate rental, and I have 45 days to identify a replacement property or properties, and I have 180 days to actually close the deal on that replacement property. Why would I go through all that? I don't have to pay tax on the sale of the property that I'm getting rid of. I simply roll it into the property that replaces that property. It's pretty big. I mean, I'm sure Roy's been involved in a few of those with his clients over the years. And I have lots of times done it myself, doing one right now. But not many people have a situation where they can engage in that type of transaction. So one of the proposals is to get rid of it completely, to just make it go away. Because again, it's a big ticket item for a very few people. That's the takeaway there. Another one that's a big ticket item that I think will affect more people, and that is to get rid of what's called a step up in basis. And what that means is, let's say mom bought a house in 1970 for $25,000. Mom passes away in 2021 and the house is worth $1 million. Pretty common. Again, the Tri-City, Tri-Valley area, very, very common. Under current rule, if I inherit that house, my cost basis is $1 million. So I sell it, I have no tax to pay. It's a beautiful thing. Getting rid of the step up in basis would mean, were I to sell that property, then I would have the difference between what mom paid for it and what I sold it for. as my taxable gain, and I'd have to pay tax on the whole thing. And again, it appears that it's just for rich people, but it would not. I mean, there are people in this country in the Midwest that have a house that mom paid $25,000, a house that's for the house it's worth 200. Not as big a gain as here, but it's a meaningful tax that they would have to deal with. $175,000 of capital gain plus whatever the state tax is. It would bring these would bring in significant dollars overall. The other is to just adjust the capital gain tax rate, which for most people is a capital gain is, I sell a stock that I bought over a year ago, I get a better tax rate. 15%, for some it's 20%, but for most people it's 15%. They could increase that to 20, 25%, make it still lower than regular income, but increase it. They're talking about that. They're also talking about, and this is a big one, and currently we can die and pass on around $12 million to our heirs, free of estate tax. They're talking about cutting that in half, maybe cutting it by 75%. So, I mean, people that have a nice 401k and a little bit of real estate, you know, that's a real conversation that I'm having with some clients that are kind of in that situation here. So they could do that, and again, very few people would be affected nationally, but locally it would have an impact. It would have a significant impact. So I don't think I've overlooked a lot of things. There's certain things. There's credits for solar. There's still small credits for. I did one today for a guy that put an energy efficient something in his house, and I looked it up and looked up the code, and there was a $300 credit. Well, great. You know, he's got a nice weekend out with his wife somewhere. So he just based on a small credit like that. So, you know, in my world, it's not always going to be a home run, hardly ever is. These are little base hits that, you know, I try to be aware of and help my clients out. And I'm a straightforward guy, which kind of leads into the faith part of the discussion. Interesting. I'm just going to pivot completely there. So we were talking earlier about, you know, kind of how my day starts is my wife and I have each a year-long Bible, and we read every day a passage from the Old Testament, a passage from the New Testament, a Psalm, and Proverbs every single day. And at some point during the day, we will have some level of discussion about some component of what we read today. And something to piggyback on the gentleman earlier about, you know, the time frame. And full disclosure, I'm not Catholic, but I'm a Christian, and we believe many of the same things, some differences, but you know, I think we're going to go where we're going to go based on our faith and our relationship with the Lord. But as far as predicting the day that the world will end, the day that the Lord will return, there's so much in the Bible that says, don't do that. It's not right. However, what I read today in Matthew was spot on of the response we are supposed to have. And it talked about the bridesmaids. 5 of them had plenty of oil. 5 of them, no, 10, had not enough oil. The bride, you don't know in that culture when the bride comes back, the groom comes back and the wedding ceremony starts. 5 of the women were not prepared. And when the groom came back, they said, "Hey, give us some of your oil." They said, "No, you're not getting any. You should have go buy some oil." But I guess the takeaway there, very timely, as I resonate with your conversation, is as believers, it's our responsibility to be prepared, to be ready, to be in that state of mind that we are in a relationship with the Lord that brings honor and glory to Him. And that's so that again was in today's year-long Bible. So, yeah, another important thing about about my faith is it makes my work in the ethical sense very easy. And maybe a scientist in the room would appreciate this. Relativity applies to physics, but not ethics. And it's a really important thing for me to stay on one bar. And I just think if Jesus is looking over my shoulder, would He be pleased with what I'm doing, with whatever work I'm doing? In the world that I'm in all the time, someone will say, not clients I've worked with a long time, because we don't work together a long time if this conversation goes like this. Well, everybody does this, underreport income. Yeah, I didn't get a 1099 for that. Not going to report it. Yeah, my wife and I went down to San Diego for the weekend. And she's the secretary of the company. So I think I'm going to write that off. Well, was the intent for business? And did you have meaningful discussions? Not really, but I'm going to write that's in there. I'm going to write that off as a entertainment and travel expense. It's not going to work. It just isn't. And again, it's based in that simplicity of faith that I mean, we know as men in the larger audience, that the deeper your relationship is with God, the easier it is to make these ethical decisions. It's when you're away, when you're not abiding in Him, that you kind of lose your way. And I'm not going to stand up here and say my entire life has been, in a close relationship with the Lord. I don't think any of us can honestly say that. I mean, we're in a fallen world, and the enemy still has many strongholds in this world. And so it's if God seems farther away, we moved, not Him. And so that's, and again, as it gets to the work I do, there's so much that we can work within the tax code to benefit the people that come to see me for their taxes. You don't need to work around it. We don't need to go behind it. And again, it's simply the easier part of being a Christian is the ethical part. As weird as that sounds to people that don't feel the same way. So I didn't have a whole lot of other things to chat about today. I'm not sure the mechanics of taking a question or two, if you want to do that, or if you want to just tell me to get in my car and drive home. What do you want me to do?
Ask for questions.
Okay. Any questions out there?
Unmute yourself.
Do what? Hit myself?
No, maybe just tell them.
Unmute yourself, and then we'll be able to have a question and answer.
Hey, Troy, while you're waiting, you mentioned to me about helping get wells in Africa.
Oh, right. So over the years, thank you for that, Roy. So a number of years ago, individual from Nigeria came to my church, Valley Bible Church in Pleasanton, and he was talking among other things about a program he was starting, because in Nigeria the government has tremendous wealth from oil. They have very, very big oil in the Niger Delta, but they don't tend to spend it on their citizenry. They don't do anything for them. So things as basic as water are difficult. So I sat down with this guy, and we talked and got to the price of a well, literally life-changing well for up to 2,500 people in a community was $600 from a plan we wanted there to water coming out. It's a primitive well. You put in a bucket, pull out the water. But what it did in a couple of communities, as I recall, the kids were getting the water in early morning. They take the big gigantic buckets, and water's heavy, and they'd walk maybe 2 kilometers to some sketchy water source to get the water, bring back. That would be, they're just tired for the rest of the day. Now with the well in the community that they had, schools popped up. The teachers would go to these communities because now they had eager children willing, ready to learn and develop and maybe get some skills that would get them out of the small villages. And so we've been doing that since 2009 with a gentleman that I've worked with in Nigeria.
How many wells have you done, do you think?
Average 7 a year, 6 or 7 a year. So that times 12, 13, we didn't take COVID off. Still did. And I've been a number of times. Partially, initially, I was skeptical because I don't know anybody who hasn't gotten a call from a Nigerian that says, I'm from the tax office and we're coming to get you. So I was skeptical. And so I went to Nigeria, and the first time and saw the products and went to many little villages where the water was there. And it was great. So I've been a total of 4 times back and forth.
Okay, you might want to repeat this. Brian Quinn has a question.
Brian Quinn, question?
Hi, Troy. So I'm a millennial, and there's a friend of mine who's a millennial here too. And I was just wondering, I know this is probably a huge question to ask, but is there anything, our finances may be different from, a lot of people in the room. Is there any kind of, advice you could give us when it comes to, saving and retirement? I know it's a huge question, but yeah.
Okay, well, so the question is, the great question is, a millennial is asking, apart from the other people in the room read that to be old, is there any strategy? Now being a young person, I would advise maximizing your 401k at work. That's really the best advice that I could give for two reasons. One, if you work for a company that has a retirement plan, that money comes off the top, you don't even see it, and it's going to stick around there for a long period of time before you start withdrawing. It may double or triple or more in value. And many companies actually match the 401k. And that means they kick in money because you're mature enough to put money in and forward thinking enough to put money in. That's a great move. Tax wise, on the tax side, I think it's really difficult because many homes of millennials are two family or two working people, where one person fills out a W-4 that doesn't take into account the other person on their W-4. So there's either huge under withholding or huge over withholding. So that's also something to keep your eye on during the year, is your withholding. But those two things more than anything else. Okay, for a okay, I'll go to the self-employed piece for a second. But that advice for any other millennials that didn't ask the question, I'm a big fan at work of retirement plans. For a millennial that is self-employed, it's just getting good organization in the bookkeeping department, getting something like QuickBooks, or if you just want to put together an Excel spreadsheet that captures all your income and expenses. And again, keep in mind, if you can connect an expense to your business, if it's ordinary and necessary for a business, you want to track it. Kind of piggybacking on that though, nobody's withholding for you because you're not an employee. You've got to be on top of paying estimated taxes. So you don't want to be surprised at the end of the year by a huge tax bill because you have to pay not only your income tax, but your social security tax. That's kind of that's a rude surprise for people self-employed. But just keep an eye on the expenses, track them well, and make sure you pay your taxes quarterly throughout the year.
Following up on your earlier suggestion about donating to the Nigerian cause, now these are not established charitable organizations. So my particular question was, last year India was affected big time with the COVID. So a lot of folks that I know did help cash oxygen concentrators. Now, is there a way, because these were not 501
C3.
would that be counted as charitable?
Great question. So the question is there a way around giving money to worthy organizations that are not necessarily in and of themselves a 501c3 organization where the deduction would be a write-off? The answer is yes, and you're in the answer where we are right now. If you were to go to, I'm not sure in this parish, in this administration, who decides where to allocate charitable contributions from the church itself. Because if they're open, you could make the case, I want to give $1,000 to this organization in India that benefits the Indian people because of this need that they have. Can I donate to you, parish, and then you forward the money to the nonprofit? Then you're good. I mean, to the need, because the church can make those. The church giving money, they don't have that same criteria.
But what if the individual are directly paid to a hospital?
You know, unless it's a 501c3 organization, you can't. And where I get that question a lot is what are those GoFundMe kind of things? Very worthy. Someone broke their leg and they can't work and their mortgage is late, and people help them out, and they GoFundMe and they slip me a receipt at the end of the year. And, oh, I'm sorry, that's the neighbor 2 doors down. You're helping them out. You're a good person, but we can't write that off. So I think with a little forethought, with a little planning, and by the way, the Wells has established a 501c3 presence in the United States. So if that organization was going to continue to have needs in the future, I'd recommend that they partner with an organization here and get some sort of deductible status here.
Do you have to donate a certain amount of dollars before it kicks in as a write-off?
Great question. So the question is there a minimum? Do you have to get to a plateau to get a write-off? The answer is emphatically no. And this year, they're making it even easier to donate, and for a married couple, even if you take the standard deduction, they'll allow an additional $600, up to $600 as a charitable contribution this year, even if you don't. And if you do itemize, and there isn't a limit. There's no the upper limit 60%, which isn't realistic. I mean, that means anything you donate. And on the bottom end, you donate $200, that's your write-off, and it's helpful. And the way you figure out the value of a write-off is you figure out what your tax rate is. Had this conversation tonight. 24% federal tax rate, 9% state tax rate. So every dollar they donated saved them 33 cents in taxes, looked at another way.
Mike Resong is next.
Mike Resong, you have a question?
Yes, sir. Thank you, Jim. I don't know if you can hear me. I'm walking around outside, avoiding
I hear you.
noise. I appreciate it. So I've been in and out of companies for 30 years, mergers, acquisitions, things like that. And the companies change 401k providers and benefit providers. Is there a way to tell if I've missed transitioning some of my money from one account to another, if I've missed time where I've been contributing and I didn't realize I had to move money from one account to the other because they, sunsetted this 401k and moved to a new provider and things like that? Is there a way to consolidate that at some point and figure out if I've missed huge chunks of money, if that makes sense at all? But yeah.
So yeah, I think I get your question. The question is, someone has worked for multiple employers and each one of them or most of them or a lot of them had 401k plans. And normally when you leave a company, you roll your 401k into a self-directed IRA or possibly the 401k of the new company. But if you just were busy and missed it, then I would go to each company. If you, I'm sure you would remember the companies you work for and ask for their probably personnel department would know who that they've worked with in administrating pensions over the years. And if you indicate the period of your employment and when you approximately terminated your employment, they should be able to let you know if you have an account there that has to be transferred. I mean, many people, I don't advise this, but many people simply leave the 401k with the previous employer for whatever reason. I'm not a big fan of that. Maybe for this reason, it's a new way I can tell clients I don't advise that, because then you forget you have money with somebody.
Yeah, and you're never going to find out if you did, right?
You'd have to go back and they're not going to tell you. They're not motivated. You don't work there anymore. So what you want to do is be proactive and contact the companies and get to the right people and just say, I might have a couple bucks with you and I just want to make sure. Yeah, great question.
Thank you.
Can we still give a certain amount of money to our adult children?
That's a question that's it's a little bit of a different question, because what that is that's the annual exclusion. It's not an income tax question. What it is that $12 million that we're able to give to our heirs is unaffected by $15,000 per year. It's increasing to $16,000 that we can give our children without affecting that $12 million lifetime limit. It's called the annual exclusion. And a husband and wife can each give that amount. And if a child is married, you can duplicate the payment to that spouse. So you can really stack these up. And for some people that are concerned about the estate tax limits, this could be a meaningful strategy to help pass on their wealth to their next generation.
If Jim has $12 million, can he adopt me?
I'm in, Roy. I'm right there. Yeah, I'm adoptable. Yes.
What causes the withholding that the IRS that comes out of my check to change so wildly from year to year? My income actually has gone up again this year, but withholding suddenly dropped.
That I think for most people that that's the question is there a reason that withholding changes unexpectedly without anybody initiating that change as an employee? And a couple of years ago, I think it was 2 years ago, they changed the W-4. You used to be able, it used to be really simple. And you'd say married, husband, wife, 2 exemptions. Okay, I'm good. And it would be pretty accurate, maybe 15 to 20% variation, plus or minus. A couple of years ago, they made it very complicated. And they said, how many employers do you have, or do you anticipate having? How much does your wife make? What other sources of income do you have, like rental income or dividends and interest? And they try to accommodate so many things. And if you just filled out married and 2 under the new calculation systems, it's going to be different. It's just going to be different. So my response is, for many people, is I'd say, leave it married. Let's say you under withheld. Let's say at the end of the year, you owed, 12 grand, because the math's going to be easy for me in a second. At the end of the year, you owe 12 grand. I'd say, is next year going to be the same? Yes. Okay. Have your withholding be identical, but have them take out an extra 1,000 per month. And then that'll take care of it. Rather,
I thought I had done that. I did that last year, and then it changed again at the beginning of this year. They did it in a big way. It was very painful when the tax law changed in 2018. For 2019, I ended up owing $7,000 when I usually get 4,000 back, because the administration decided to just arbitrarily, since they said you're going to get a tax cut, which I didn't get, we're going to give you a bunch of money to make you feel like it.
so the follow-up is this, that they kind of did a head fake, and they said, look, all of you people, we're going to change withholding, and you're all going to get more in your paycheck. You're all going to get a bunch, and people did, but they didn't change the tax rates at the same time. So all they did is change people's ultimate result. So what my clients that have worked with me a long time, that are employees that have that reality, once or twice a year, they send me their paycheck stub to that point in the year. And then I give them kind of a heads up. I say, well, basically through September, you're over withheld by $4,000 or under withheld by $3,000. So here's how we can accommodate that and break even by year end. So the people that work with us we're not just filling the forms out. We're trying to anticipate and smooth those wrinkles when we can.
For years, we did use plenty of bottom line to get set, and now it's changes all the time.
Yeah, and again, that's just amplified that point. Yeah.
So back to the faith side of your experience, I think you alluded briefly to none of us travel a straight line. Did you run into a low or a high in your path?
Yeah, so at different points, and I can't say that, my relationship with the Lord has been a lot more linear. As I'm 60 years old, and in the last 10 to 15 years. But, as a self-employed person, in my early to mid 20s, there was a lot of pride associated with, how I thought, I was pretty important. And I thought at the time I would let God help me, but I was really in charge. So over time, in this point in my life, if he's not president, he's not resident. So my life is governed by again, that philosophy now that I need to bring honor and glory to him, and everything else is just fluff. But to your point, different points in my life, and it always comes to pride. I think that's an issue for most men, and whether they're believers or not. I think is at some point we think we have it figured out, and God is merciful. He's patient. He's kind. The grace that we have. I mean, grace is God's riches at Christ's expense, and I truly believe that what was done on the cross for us. And once I think about that, it's humbling, and the pride kind of melts away. But as far as the different points in my life, they were always related to pride. Yes.
I asked this question because you give me the impression that you can handle it easily. What do you get out of being Christian? What's in it for you to be a Christian? Well,
the fact that as a Christian that we have the hope that we have, the hope that this world is just, we're just, I think, travelers, if I could use that term, through this world. I mean, you look at the concept of eternity, of leaving this place for a better place. And that hope is what, when we deal with COVID, when we deal with death, when people have a loss of a child, when people suffer through a divorce, when all the things, business failure, financial ruin, things like that, the hope that we have in the Lord is what I cling to, is what gets me up in the morning. Again, this is the day the Lord has made. I will rejoice and be glad in it. And that's, my approach to the day. Again, maybe in the last 10 or 15 years, that's been an increasing linear part of my path with the Lord. Prior to that, again, it was was again, I thought I could handle things on my own.
I'll verbally ask if there are more questions.
Any more questions before I turn you guys loose?
I have one more for you.
Of course.
How do you feel the presence of God in your life?
So, and I'm not Catholic. I'm again of a different faith. So when I accepted the Lord as my personal Savior, my personal belief is that you have an indwelling of the Holy Spirit, and you think differently. You process decisions differently. You approach others differently. And so that continued presence of that abiding presence of the Holy Spirit stays with you. And that's how I feel the consistency of a walk with the Lord.
I'm not sure whether you're Catholic or we belong to the Valley Bible Church, because everything you said should ring true to everybody, I think. So thank you.
Thank you. Thank you, Roy. And I mean, I think there's more unity than disparity between many denominations. But I want to echo, I mean, I've been in situations where it was mannered and formal and rote, and I didn't feel that the Lord was really present in a few of the different churches I've been in my life. But it's, again, I know it when I see it. I know that I'm in the presence of people that have a relationship with the Lord. It's clear.
Well, you're welcome here.
Thank you. Thanks, guys.
Thank you. Thank you.
Mike Resong wanted to ask if you're accepting new clients.
Sure, yeah.
Okay, he is accepting clients, and I will share contact information with everyone all around. Now, at this point on the agenda, we have time for a wrap up, and then Marcus is going to lead us in prayer. Anyone have any closing remarks? Okay, listen, I want to thank you from the bottom of my heart. We met tonight. I mean, you could tell this man's a Christian. I mean, it's just amazing. And you don't run into people like that every day. And it's a blessing that you came to be with us.
Me too. Thank you.
Thank you. Marcus, can you unmute yourself and lead us in a closing prayer?
Absolutely. Can you hear me there in the hall?
The people online can hear you for sure, and we can hear you now.
Okay, cool, perfect. All right, in the name of the Father, the Son, and the Holy Spirit.
Amen.
Lord of day and night, of beginnings and endings, as we prepare to conclude this meeting, we once again lift up our hearts to you, the divine source of all life. We thank you for the gifts that have been present tonight, for the gifts of fellowship and understanding and of mutual respect. We are grateful for the gifts of perseverance and insight to the common concerns that we share tonight. For these and all other graces, we are thankful. As you have blessed our coming together, now bless our departure. May your blessing be upon us. In the name of the Father, Son, the Holy Spirit. Amen.
Amen.
Thank you all, and thank you all for coming for this strangely hybrid meeting. Next month will be steak and sausage, and Father Mark, it should be a nice homecoming. And I don't know, Troy, if you're in town, come by. I mean, we would be blessed to add you to our number just as fellowship. So anytime, any month, 12 months a year, you're welcome here. All right.
The second Monday.
Usually the second Monday. Yeah, usually the second Monday. Okay, thank you, everyone. And I will send out Troy's contact information. I chatted it to you already, but for those of you who aren't quite as fluent, I'll send out an email. I have a record of everyone who attended. So thank you very much, and God bless you.
Take care. You too.
Thanks, Ron.